Hello traders. So to be successful in the forex market, you have to know what to do and what not to do. You also have to know the best conditions to trade and the conditions that don't suit trading. Most of the time, the success in the forex trading has been linked and connected to what to do, what strategy should you use, what approach should you take when trading the market, what should you learn and what should you study in terms of forex trading. But it's important to also consider the flip side, because if you ignore it, then all this information that you have might be in vain and it may not be practical when you try to apply it. So it's important to understand that, first of all, it's not all market conditions that are friendly for trading. So there are market conditions that are actually unfriendly for trading. And in this video, I'm going to teach you the top 5 things to avoid. So these are the top 5 conditions that when you see, you need to probably avoid trading. I'm going to be explaining each one of them and why exactly you need to avoid trading when you see such conditions. First thing to avoid is the consolidating market. So this is simply a market that has price in a specific range. So in this market, we have a specific price range where price is unable to break, like in this rectangular pattern here. And it signifies that we have price indecision because neither buyers nor sellers are strong at that particular point. If buyers were strong, then we will have a breakout to the upside. If sellers were strong, we will have a breakout to the downside. But as you can see in this zone at that particular time, we had no breakout either to the upside or to the downside. Instead, every other time that price tried to break out, it came back to the zone. So that's a consolidating market. So the fact that it indicates we have price indecision is the first and the main reason why you should avoid trading such a market. Because if we have price indecision, that means the market the market is confused by itself. So if the market is confused, you as a trader, you're not in a position to take a trade. Because if you're taking a buy or a sell trade, it means that you need to have a solid factor to confirm to you that the market should either buy or sell. But the fact that the market is consolidating, it shows that there is no specific reason to be taking a trade since price is confused and we have price indecision. I always say that as a trader, your work is to follow the lead of the market. So the market leads and you follow. So when the market shows you confusion, then that means as a trader, by default, you're also confused. So there's no way you can take a trade at that particular point. I've actually done a video on how to approach consolidating markets and the way that you can take a trade afterwards. The link is in the video description. The next condition to avoid is a choppy market or a spiky market. A market that is choppy, or rather a market that has spikes, is a market that is full of shadows up and down on almost each candlestick. So we get to a point like this where we have a series of candlesticks. Let me just mark this zone so that you can see. So don't focus on the trend line, I'm just marking the zone. We have a series of candlesticks which are very choppy. You see, we have long shadows to the downside and to the upside. So we have all these series of market. So this market is very confused also because when we have these spikes up and down, it's a very bad time to trade. Let me show you a better example. So here we have pound, this is GBP CHF. I want you to look at this behavior of the market at this particular point. So this is a perfect example of a spiky market. So these are the spikes. You see, we have shadows to the upside. So these candlesticks have so many wicks, both to the upside and to the downside. So the problem with such a market is that it's very confused in terms of its price movement. And you see, at one particular point, you even get a bearish candlestick. You think that the market wants to drop, it goes back up. You think it's now buying, it goes back down in the same series. So it's not exactly a consolidation because price is not in a specific range. As you can see, it even comes and breaks below the range, but again, it continues going up with the same series. That's a spiky market. Whenever you see a spiky market, just like a consolidation, you want to avoid such a market because it can be very harmful to your trading. It can be very manipulative and it may not respect your technical analysis. In fact, I advise, if you trade a currency pair that is full of spikes, you might want to avoid such pairs because they might not be very friendly. So if you want to trade a market, you need to find a market. This is one of the best times to trade. I want you to look at the behavior at this particular point. See how the candlesticks are dropping. We have long bodies. We have very little shadows to the upside and to the downside. So having the shadow is not the problem, but if you compare the smoothness of how the candlesticks are moving here and at this point, as compared to this choppiness here where we have all these shadows, you see there's a very big difference. So such a market you want to avoid. Third condition is when we have the release of high impact news. This is just an example of a high impact news that has just been released currently a few hours ago. I want you to just see the impact of this on the chart. Before I even break down this, let me just show you how to view your news. I use investing.com. We have several platforms, but I prefer investing.com. You can just search on it on the internet. So on investing.com, you come here and you'll find news of several currency pairs. You can customize it by selecting here on the filter, by selecting the specific countries that you want to receive news on. So I receive news from on currencies, I mean that I trade. For instance, today at 7:30 a.m. we had RBA, that is the Republic Bank of Australia. So we had the interest rate decision. So you can see we have the forecast, and we have the previous. So the previous is the previous interest rate as was released the past report. So the forecast is what they are forecasting. So if the actual data comes out, higher than the forecast, it means that the economy is actually doing well. So in this case, the interest rate came out very positive. Their forecast was 0.6%, but the interest rate report reported 0.85%. That means that the interest rate is very positive. So looking at Euro Audi, just to see the impact of the news that has just been released a few hours ago, the Australian dollar interest rate has come out positive, meaning that the Australian dollar is strong. So in this case, having Euro Audi, since Australian dollar is stronger than the euro, it means that the euro is actually weaker. That's why we had a strong drop in price. But news can be very manipulative. You see, as much as the news came out strong, you might expect that Australian dollar should be dropping until right now. But what happened is that we just had an immediate impact of the news. So this candlestick actually dropped with over 100 pips, which is very unusual. So we had a 122 pip drop candlestick. And if at this time you thought that no, the market was bearish because the news has come out in favor, you took your sell trade, the market has gone all the way up and it's actually in a consolidation as if it wants to even buy. So in other words, you need to avoid trading the news because number one, you cannot predict the outcome of the news. You can anticipate, but you should never try anticipating. Let it come out the way it will come out, but don't try to predict the outcome of the news. Another reason why you don't want to trade the news is because it can be manipulative. Like you can see here right now, though you might be right that the Australian dollar interest rate was going to come out positive, therefore Euro Audi had a higher chance of selling. You were right on it, but there's a high chance that you maybe didn't make money because of how this move occurred. It wasn't a straight drop as compared to this drop that was happening here where price was just dropping instantly. So this is sort of a manipulative move. So you might see it coming to drop eventually, but higher chances are that you've already hit your stop loss. So you want to avoid news because of this reason. It will save you a lot of losses from the market. Fourth thing is when we have bank holidays. So when you have a bank holiday, you want to avoid trading that specific currency. It's the same thing. You also come to the same website, investing.com, depending with the platform that you prefer to view your news. And whenever you are scrolling through, whenever we have a holiday for a certain bank, you'll be able to get it here. So when you identify that we have a certain bank holiday, it's advisable to stay out. Because when we have bank holidays, you need to know that banks are considered one of the biggest market players. So when the bank closes, there's definitely going to be a drop in the overall trading volume and the liquidity. So that means we will have an effect on the volatility of the specific currencies involved. For instance, this is the Euro Audi. Let's assume we had a bank holiday of the Bank of Australia. So when the Bank of Australia has a holiday, there's a high chance that they won't be processing orders. You understand? So there won't be much activity on the Australian dollar. So the fact that this is euro versus Australian dollar, you might want to avoid pairs that involve Australian dollar, including this one, because there might be very less volatility. And when you don't have much volatility, that means the market might not move quite significantly that day. So you don't want to be taking your orders or placing your trades such days when we have very little movement of the specific currencies involved. The final condition is, first of all, I want to make it clear that this condition might be very personal and very subject to you as a trader, because if you've learned forex trading, then you should be able to identify the market structure. But there are specific times that you might look at the market, and based on your understanding, it's hard for you to define the structure of the market, because at any point the market is either bullish, it's bearish, it's in a consolidation. For instance, based on the market structure understanding, you should be able to identify patterns on the market. You should be able to identify, let's say, an M pattern. You should be able to identify heads and shoulders. For instance, this is a formation of something like a name pattern. You should be able to identify patterns like heads and shoulders. So based on how these patterns actually form, they help you to identify the general market structure. So they help you to know that the market structure is bullish or bearish. So I'm not saying you should look for patterns all the times. It could even be based on the candlestick's behavior. And again, I've insisted that this is very subject to you as an individual trader and your understanding on the market structure. Anytime you look at the market and you cannot clearly define the structure, you cannot tell whether the market is bullish or bearish. You are not sure. In other words, you need to avoid trading such a market. So that's it for this video.